Marcie, great to have you with us. Thanks so much for joining us. How is your reaction to the recent turmoil, more around private credit, but around private assets in general?
I just, interestingly enough, I'm here at an event with both my head of private equity and the chief investment officer, and we're having this conversation yesterday. And, on the private credit side, we've been very specialized and working only with, high quality managers. We had a 8% allocation to private credit, and I think we're hovering around 4%. And we believe that that book is diversified enough that, the team is really not too concerned about the software exposure that we're hearing a lot about. On the private equity side, I know that was part of your intro. We're really proud of the private equity book and the reworking, of that book over the last 2.5 to 3 years. We did post a 14.3% private equity return last fiscal year. On the private debt side or the private credit side, we did post a 12.8% return last year. So we still have a lot of conviction in our private markets allocation and don't really see a need to change. But as always, we're very thoughtful and considerate around the managers we're working with, making sure we have good values alignment, but also making sure that the portfolio stays very diversified as we look through, all these different market cycles that seem to be approaching us.
And you said your current allocation works for the next 4 to 6 years. What gives you confidence in that time horizon, and what risks are you looking at?
Yeah, so on the private equity side, we're in a very strong liquidity position, and I know that that is not the same case that many of our public pension peers find themselves in. I know that there are public plans out there actually reducing their allocation to private equity and private markets generally. So we believe that the recalibration of the book that we did about 3 years ago, how we do manager selection, the reduction of fees. We've reduced fees by about 100 bips in the portfolio over the last 3 years, which is phenomenal. It's just a great, some great recognition for the team. So manager selection, reduction of fees, including more co-investments, and as well as emerging managers. We still have very strong pipeline around emerging managers. We're targeting about 10% of the portfolio there. We went back into venture capital. There was a time that CalPERS stepped away from venture cap, and the team has found a way to re-enter. And again, about 10%, maybe up to 15% of the portfolio really focused on emerging managers as well as venture. So we have a lot of conviction because we've seen how this new recipe has worked for the team and for CalPERS over the last 3 years, and we don't see that effectively changing over the next 4 to 6, including the liquidity position of the portfolio.
Marcie, there are, even if private credit firms had done great due diligence and made really good loans, because of investor fears, there are some looking to unload those assets. Have you been approached by private credit operators who want to sell you some of their loans?
Not aware personally that we have been approached. We certainly have done some secondary sales on the private equity side of the house, but I'm not aware that we've received, incoming calls around selling off of private credit books from our peers.
Would you be a buyer? I mean, are those conversations that CalPERS would have and, look at some of these assets and say, you know what, we think it's a good risk, a good credit, and we'll take it?
If the team, we'll always take a phone call, but if the team felt that it diversified the portfolio in some way, the terms were in a way that, because we do have a little bit of, runway on the allocation. I think, again, we sit around 4%. We can go up to 8% of the book. But I think the team would be open to taking the call. We have a new head, we call them managing investment directors. Masha came in and is looking at how to really expand the strategy that we have in private debt and private credit. We've really done more in direct lending, some in specialty lending, but really, expanding that strategy, I think will be, just a real piece of, her time here at CalPERS. But yes, we'd always take the call, and if we felt the terms were right and it diversified the portfolio in some way, certainly we would take a look at it.
What about energy and renewables? Where are you currently seeing the most compelling opportunities there, and how do those fit in your broader risk-reward objective when it comes to your portfolio?
Yes, as you recall, we did a commitment as part of our sustainable investments to do 100 billion by 2030, and half of that is really the exposure that we already have with listed companies, about 53% of that 100 billion, which leaves the rest around energy transition, or what we call climate solutions. So whether those are mitigation, or whether those are adaptation, or whether those are real truly new innovation around climate, whether that's methane capture. So we're on track. My team has absolute confidence that they'll be able to find the right deals by 2030 to get that 100 billion working for us. But we're finding a lot in venture. Those tend to be, again, smaller checks for us. But as you come in early to venture, we're hoping, we stay with that company as they continue to build and go through their various series. But we're finding that public companies are doing a lot around transition, and we want to reward the companies that we think are moving in the right direction. And so we do get some criticism now and then, because we do have some oil and gas exposure in our calculation, because we do think that some of the oil and gas companies are investing appropriately around reduction in greenhouse gas emissions, or investing in methane capture, or investing in just how do we continue to support the energy transition when we know that there's a huge energy drain coming from from AI and the capacity that's needed to run those data centers.
Speaking of AI, I wonder about your take on software. Marcie, obviously, the last, as we played that shot from Bruce Richards, the last few days and weeks, there has been real concern whether or not you believe AI is going to eat software's lunch. Do you find discounts there that make you want to buy?
I think the team is always, looking at, especially on the private market side, looking for where those innovative plays might be. But, as far as AI for CalPERS, we look at it in a couple of ways. One, internally, operationally, how can we use AI to become, more efficient, more productive? Those operational efficiencies are extremely important, as well as the insights that we think that this vast amount of data that we have at CalPERS, how do we access that more quickly, make better, more informed investment decisions? So operationally, the team has been using that. And I would say in particular on the sustainable investment side of the portfolio, a lot of work happening there as we're discovering, good climate solutions and good investments for the fund. But I think, AI, from an investment standpoint, we're doing a lot of engagement with public company CEOs on how they're approaching it with their company. How do they see monetizing this better in some way over their next 2 to 5 year business planning cycle? And those engagements are going well. Obviously not something I can talk too publicly about, but our corporate engagement team has been quite active and trying to understand where, these listed companies are, maneuvering, and how they're developing out their plans to, take full advantage of what AI will eventually bring. But I would say there's 2 sides of it, or 3 sides. So operational efficiencies, productivity, and insight. How do we invest the portfolio through our public companies? And then finally, where's the innovation in the private market side that we can get in early?
I mean, on the operational side, as CEO, are you finding you have big bills from software as a service companies that you can cancel by doing it yourself with AI?
We haven't gotten there yet, but interestingly enough, we are in progress of implementing some new data and technology initiatives, and those are very tough questions that we're asking those software partners today. Those costs are coming in very high. How are they taking advantage of AI and its benefits, and what does that mean to cost reduction for CalPERS? So these are conversations happening today, and I would expect to see reductions in just our operational costs around software.